market is now open. There's your regular trading hours gap. We have a regular trading hours buy-sell liquidity pool here, and there's a line just right above that. You view it from a hourly chart. From this candlestick up here is low to this candlestick's high that's annotated right there. That's a sell side imbalance, buy side inefficiency. You look past that, go over to this little area here. This is a balanced price range because of this candlestick's portion on the upside and the downside. So if we get a little bit of a run above the buy side here and we get into this area here, how far can it run up? Now, this is barring, this is what I said to my kids. If they start dropping bombs in Venezuela, then obviously, the market's going to do whatever it's going to do. But all things being equal, and there's no disruptions, I think that for a premium level, this is where I'd like to see it get to. Doesn't mean it can or will. That's where I'm aiming for. We have a new week opening gap here, right there. I have that graded on a 1 minute chart. Here's the buy side I told you from regular trading hours. You have to know those levels, folks. If you're just looking at the electronic trading hours for market structure and for liquidity purposes, you're losing sight of what's available to you because of overnight, over the weekend, that type of thing. It's important for you to know what those levels are because they're going to be pertinent. Let's say this is the new week opening gap here. So in other words, this is where we stop trading here. Okay, here's Friday's settlement. And then we opened here on Sunday at 6 p.m. So the difference between those 2 price points, that is a new week opening gap as we define it. And then we grade that. That means we're simply placing a Fibonacci on it. It's the lowest quadrant, equilibrium, or consequent encroachment because it's a gap, upper quadrant, and the actual opening price. So that's your range. You want to have that throughout the entirety of the week and also keep them on your charts for about 5 weeks. They go a little bit longer than that. I've used older ones than 5 weeks. We came down into the new week opening gap and noticed that the bodies did not even trade to consequent encroachment there or the wick. See that? And we consolidated around the upper quadrant. And then right here, we failed to get down to the upper quadrant. So we have a failed attempt to get to consequent encroachment. That's bullish in and of itself. Failed to get to upper quadrant here, bullish in and of itself. Keyed off the upper portion of the new week opening gap. And then look what it did here. Failed to get to it there. So what is it doing? It's building some kind of a narrative that it's under accumulation. It's under accumulation. And that means we're going to build a pool of liquidity, some stops. So traders that are going to see these levels as retracements, harmonic patterns, they'll run on them. And that's what this dive down here is. They wipe out that, go down to the lower quadrant, fail to get to the low of the new week opening gap. Then we start accumulating again, and watch what happens. We hit the consequent encroachment, upper quadrant, doesn't come back to the high of the new week opening gap and starts building all this run in here. All of this is a precursor to how we're going to trade the opening on a Monday with a new week opening gap. They've already did the damage down here. There's no reason for it to want to go lower. Pre-session before 9:30, it drops down, gives us a little bit of a retracement inside of this range here. Beautiful displacement down into a buy side imbalance, sell side inefficiency right there. Rips up into the regular trading hours buy side, up into the hourly SIBI, and by itself, trading in the first few minutes just on a momentum basis. Start of a new day, start of a new week. This is one of the easiest bread and butter approaches where it's fast bias, real quick. And I know some of you are going to still ask me, how could I have known, or how could you have known that it was going to go up? Well, I started off right away, right to the point. Potentially viable to anticipate these levels traded to. The PD arrays that I teach, the PD arrays that I show you, if you're looking for indications of bullishness, bearishness, strength, or weakness, if they fail to even trade to them while bullish and you don't see them touch them or come down to a discount, that's huge information, it's insight that's beneficial. And by having that information, it allows you to say, okay, well, if I have a bias, I think it's going to go higher or go lower. And if I'm seeing these PD arrays that are obvious and grading these levels that are gaps, if they're not being traded to, that's the price indicating to you algorithmically that, we don't need to go there. We have someplace to be right now. We're under our schedule and we don't have time to dilly-dally around. We got to go. And it's just like a gunshot, boom. You're anticipating the hit and you see it right here out the gate this morning. Okay, so that's probably me not doing it correct again, right? So let's go back out to an hourly chart. Again, just for today's purpose only, this is about as high as I would anticipate just for the morning session. Now, that doesn't mean it can't go higher. Doesn't mean it can't stop right here. It's already done enough for me. And for anyone that's trying to trade the opening range, This is how you can do it where you don't have to wait for a fair value gap or a first present fair value gap. I don't need that. It's just for me to teach you how to find where the market will be going next and where is it going to originate that run from. And then by teaching you that skill set, it helps you build a baseline foundation as to what the market may reach for. It's a rhyme or reason or a protocol to follow every time you sit in front of the charts, because if you don't have that, it's a waste of time and it's very frustrating. And then what you'll do is you'll turn to other people live streaming and listen to them talk about things that have nothing to do with why price is going to go up or down. And they're time wasters. So a balanced price range is any portion in price action where we have a distribution of delivery, both sides. For a very simple approach to explaining that, I want you to think about how this price run from place. In this price run, we have an inefficiency right here, where it's just one single candle traversed between the previous candle's high and the next candle's low. That range between those 2 price points here was only distributed to on this single 1 hour candle. That's what we refer to as an inefficiency. It's inefficient in sell side delivery because this is buy side delivery. It's delivery. It means the movement of one point to the next, where price is traversed. In this case, it's moved higher. So this is buy side delivery. It's inefficient in sell side because it hasn't moved back over top of this range at all until we got over here. But it left a small little portion right there in deference to that low and that candle's high. Now going lower or to the left even further, you had this one. I like this one because it's anchored to an order block. Why not this one, ICT? This one here, because we have 1, 2, 3 down closed candles. That's all one order block. It's one single delivery of sell side delivery. It's one single block of price action that moved one direction. Its opening is here. That's the change in the state of delivery. That resides very close to the midpoint of this gap here. I'm incorporating this volume imbalance, which is the difference between this candlestick's close and this candlestick's opening. So there's no bodies connecting here. It's just the 2 wicks that are joining and touching. So that's our volume imbalance. This portion of price action being delivered to the upside, leaving the order block. I like that in and of itself because it's a fair value gap that's going to be utilized and more likely to be influential over price action because it has more than just simply one candlestick saying, hi, I'm a fair value gap. It's anchored to some other PD array, which is this order block. So it leaves it here, and this portion on the upside, that single 1 hour candle going up, it's overlapped with this portion of this single 1 hour candle. So the open here, that's the high of the buy side imbalance, sell side inefficiency. It's not a suspension block because there has to be a volume imbalance to the lower end too, not just one side. So this is a buy side imbalance, sell side inefficiency. This candlestick's high is the low of this BISI, B-I-S-I. Buy side imbalance, it means it's one directional. No other candle shares this range at all until we get to this candlestick right there. And notice what it's done. One single pass here, and then one single pass here. So that makes this portion of price action right in here a balanced price range. Well, it means that if price can trade up to it, it's going to be a formidable foe in terms of allowing price to cleanly cut through that. It doesn't mean it can't, because if there's a geopolitical event that takes place, something that was unexpected, then obviously you can see that there's very little in terms of resistance keeping price from going wherever it wants to go in extremes. But here, it's a wonderful objective to reach for on the upside, because how far could it traverse into this portion here? Well, you can grade this high to this balanced price range low, and you can get quadrants there, and you can see how it eats into that, and we'll do that now. And all I'm doing is showing you how to grade an inefficiency between 2 PD arrays. There are so many things that you can study and ferret out of price action when you understand how price is actually booked and what liquidity and inefficiencies mean in terms of price. This range here, from here, I'm not anchoring to this candlestick because of this time. It's the range. The high of that candlestick is what we're framing for this portion of price action. It's balanced price range. But we can see how price dug into the lower quadrant of that range and failed to get to the middle. So until we get a close above this, the range is defined by what we have here in opening range. So this is the initial short-term high during opening range. We're entering the macro right now. So it's 950. And we'll see what we see in terms of price action. But now we have a marker that delineates if it can take out this high and close above this halfway point that's being highlighted here, then we would be bullish. And I would only be bullish up to this candlestick's low in the lower quadrant. Halfway point, I wouldn't be interested in that, only just for day purposes. So in other words, like PM session, lunch macro, all those types of things, final hour trading. This is the furthest I would expect for today. Not that it can't go higher. If it did, it would just move without me. This is the new week opening gap range highlighted here with the gradient levels. We're going to do the same thing with range gap. So we have the opening here. So here's midpoint. There's usually about a 70% chance that can be traded to. So half the gap by 10 o'clock. We only have about 8 minutes left to do that. I wouldn't be so demanding that it does it today, but that's always a potential idea that I like to look for. Is there something that would support that idea? There isn't anything yet technically to support that here, but that's something that as a teach, having a gap in the morning between 9:30 open and where we settled the previous day is a wonderful opportunity to study that premise. There's a rhyme and reason why price does certain things, but simply me saying it isn't enough. You have to be able to look at it yourself, measure the importance because you've seen it happen this many times out of this many observations and drills looking for it. This right here, 931, that's the minimum criteria for a first presented fair value gap. First presented fair value gap, we'll just classify it as 931. It's the earliest it can form. And what that does, and how I was aiming for trying to eliminate a lot of confusion for them, because there's going to be some times that if you look at electronic trading hours, which is not what we're showing here, sometimes when you have electronic trading hours in there, you'll see it form a fair value gap right at 9:30. And there's a lot of rules that go along with using a 9:30 fair value gap. But I'm trying to keep him focused on the things that are so easy to follow and a lot of the extra extreme rules that come along with trading on that first 1 minute candlestick. It's not imperative, okay? And honestly, if you only stick with 931 as your earliest potential first presented fair value gap, it will yield so much more clarity and remove a lot of the uncertainty and ambiguity also when watching price action. You'll just know, I can trust this because these points of reference hold up more time than they fail. So we have a minor buy side here. We already, like I said, we ran above higher straight from the opening bell. First presented fair value gap is here. And you have a volume imbalance at the high end of it. Okay, so that would be first presented fair value gap. Day session, that means electronic trading hours. We have sell side formed here and we have buy side here. They would be considered minor buy side, minor sell side, because it's just simply the first range that was formed inside of the first 30 minutes. By having that reference point, what you'll be able to determine is which one does it run for next? What's the benefit of that? It helps you trade the silver bullet that forms in the 10 o'clock hour. If we run up and take this out here, what we would want to do is see it stay running towards that balanced price range I showed you on the hourly chart. If it were to go above this high here and falter and break lower, then chances are they're going to probably run for the sell side. And if it's going to do that, then we have to consider the upper quadrant consequent encroachment for the opening range gap. So it's a if price can do this, then I'm going to focus on that. While it's in the middle like this, do nothing because it's already given you a run here that was profitable. Minor buy side over here and that level here I had already on the chart and it cleared those. And it's fallen short of that dynamic range measuring that inefficiency between the hourly balance price range and the low shown on the hourly chart. And when I did that grading, that's what that says here. For clarity's sake, I'm annotating this here as the midpoint. So as long as we're below this, it's likely that we'll run for the sell side and maybe try to work in towards the consequent encroachment or midpoint of the gap that was the opening range gap. Trading above that, then the low of the balance price range on the hourly chart. So we have first presented fair value gap. It trades down into that. Minor buy side is in striking distance, and that halfway measurement of consequent encroachment on that dynamic range on the hourly chart, it's just above that here. So that would be the deciding factor. If we can take out that high, how do we use this level? Does it trade above it and close above it? If it does, then it warrants a continuation, in my opinion, that it would reach for the balance price range to the upside. If it trades above this and fails to go here, or it trades above it and wicks through it and then closes back below this candlestick's close, which would be what? The rejection block. Then it would be more likely that it would reach back down and run the stops here. And then the opening range gap becomes a primary concern. But right now, sticking with the strength of opening up in the direction of the opening range gap, that means where we stopped trading Friday here and where we opened today. That's what the difference is, okay? That's our opening range gap. We made our way up into that consequent encroachment again. So this is the high of that candle, and that's the low of that inefficiency or dynamic range. This portion of the drop down, how much can it trade up into? Is defined by this candlestick and that candlestick, because this is the buy side delivery and this is the sell side delivery that makes up this balanced price range. So think of this like the firmest boundary on the upside that I would see for the morning session. And I would be content if it could trade there. And I wouldn't have any desire to demand that it gives me more than that. Doesn't mean that it can't go higher. It just means that if I were in a long, I would be content with scaling out here something here at the upper quadrant, and then definitely closing it right below that level there, because many times you've seen me be so precise that my limit order would be the high and it won't give me the exit because it simply just went to the price and didn't allow the spread to engage the limit. You can see how it's delivered. We used this new week opening gap initially. Whenever you get a new week opening gap and it trades down and closes it ahead of the morning session, as we see here, it's Monday, November 24th, and that formed at 5 a.m. this morning. So that's 2 hours before our early pre-market session, which is 7 o'clock in the morning to 10 o'clock. And that is the encapsulation of both Forex and futures trading. So the rules are there for no matter what you trade. Your trades went down into that new week opening gap here, where we settled on Friday and where we opened. It trades down to 3/4 of that, and then rallies. It's a 3/4 mark there. See that? And we traded up, ran in the direction I gave you, drove into the level I told you, and now we're underneath the condition of, do we close above this? On the 1 minute chart, you can see we laid down a couple bodies. We closed above it here. We closed here. And now there's a volume imbalance with the fair value gap there and an old high that has a wick. So what we would do with something like that is you want to measure the wick. We would want to see the body stay in the upper portion of this wick if it remains bullish. It could be done for the morning session and then a deep retracement going into the 10 o'clock hour, and that might be the criteria that's used for silver bullet. But here, to see a sustained run up into the balanced price range, which is up here, I would want to see the body stay in the upper half in this blue line here. Like, see, this is permissible, that little drop down here, but I would want to see the body stay up here and then start to resume going higher. Otherwise, we would already have a scaling of partial profits here, limit orders resting here, and then something right below that. I came out live right out the gate, told you directional bias, the narrative as to why it would be utilizing that. It traded to, actually, how many targets I hit? This one here was the first one, minor buy side. Then we have the level here from the hourly chart. And then we had this minor buy side traded to, and then the consequent encroachment of that dynamic range on the hourly chart. So there's 4 targets right there. So it's filled 4 numbers. So you would only have about 20% of your original position on that you went long on, because it already gave you an optimal trade entry long there. So it's already showing a willingness to lay a body down below here. So it would need to immediately reject that and go higher, or we're probably going to roll over and start trading right back down into this portion of this consolidation. And then what you would do then is measure the high to that low. Where would the equilibrium price point be in that? But that's right here is the equilibrium of this range. So the last line in the sand for morning session bullishness would be this line here. So halfway of all this consolidation, which isn't all that big of a deal because it's really just a 1 minute consolidation, it needs to stay above that. So in other words, it's okay if it trades all the way down there, but if it repels back above it, then we would want to consider, again, all the things I mentioned up here. Otherwise, if we lose this level here on a closing basis, my morning session bullishness is now pushed to the sidelines. I would be done. Meaning what? My stop loss on the position that would be long down here would be resting just below this. So now think about it like this. We've had a run right out of the gate here at 9:30. So there's 9:30. We have first principle the fair value gap. We've had 4 levels filled. We have sell side resting here. And that was the run that took us to this level there. If we lose the middle of this consolidation, in other words, look at it like this. So this block of price action right there, this consolidation and price action, halfway is right here. That's equilibrium. So if you ever study how price moves from trending or price swing higher, then it moves into a period of consolidation like this, which is how I was teaching the elements to a trade setup. That's the first lectures in the paid mentorship. If you study that, I talk about how there's retracements, expansion, consolidation, that type of stuff. This is where markets are in consolidation, and then they have an expansion run. Now, if it's going to trade back down into this consolidation, we want to see it stop at the midpoint. I want you to go back and look at anything. Look at stocks, bonds, look at currencies, look at even crypto stuff. Consolidations, when bullish, only trade down if it can even manage to get down to halfway. That's usually the halfway point sensitivity, and then it resumes going in the direction it wants to go on a higher time frame basis. Having this understanding of consolidations when bullish are very sensitive in the upper quadrant or upper half, just like I teach with the PD arrays. The same application I use with individual PD arrays is what you want to use at consolidations. It's the same school of thought with market structure. We have a small little gap in here, and price traded down into upper quadrant of this consolidation. And look at the sensitivity there. The bodies wick down, yes, fair value gap, and in this wick traded right back up to the old high, which was what? Consequent encroachment of the dynamic range I gave you on the hourly chart. That was between the balanced price range low and the other level I anchored to on the hourly chart. Bitcoin chart 2 Mondays back, and I told you that we would be trading down into this area here on Bitcoin, and then it tanked, went lower. It traded into this candlestick here. It's a down close candle. It's a bullish order block from the high to the opening. Just changed in state of delivery. Hits that, and now we're just meandering around inside here. So it actually went further than I called for. The dollar index told you that we would be using higher prices as our expectation. And this here is defining this market maker buy model. This is a 70.5 level, if you remember that. And then look how we came down recently here. So this was after the live stream that I gave you. It came down to the 70.5 level, and it's the lower quadrant of this buy side bound sell side inefficiency. Hits that here, runs higher, and then we run out the high that's formed there. There's a small little pool of liquidity right there. That would be the next point of interest for me. There's no inefficiency here, and we have a volume imbalance there. So if it pumps above that high, that volume imbalance right there, have that on your chart, because that might be a point. That's the next area I would expect. If we resume higher in prices for dollar index, that's where I think it would go to next. So we have buy side there, and then we have a PDA right above it, which is that volume imbalance. The euro dollar, like I said, I would not be trading Forex right now. I just simply wouldn't. There's nothing here that is exciting. There isn't anything that stands out as this really wonderful price action. It's just really crummy. And I know some of you are just only trying to trade Forex, but because we're knocking on China's back door from a proxy perspective, because they're building a relationship for their natural resources and whatnot. And we want to kind of like keep China from being able to utilize that. Plus, they're real close to us by being down there. It's getting ready to pop off. So that's going to actually have a lot of reverberations in the marketplace. And you can see it really in the currency markets. Currency markets are very forward looking, like the bond market. And the bond market tends to anticipate, whereas the currencies, when they start to contract, that means something's in the offing on the horizon. And it's usually something geopolitical. When it's free and loose and moving around, then you can sleep at night knowing that there's no risk. Here, it's waiting for the next shoe to drop. That means something big is about to take place. And that's why I warned you before, be careful if you're trading currencies, because I would not want to be out there and have some kind of crazy wild run like the Swissy and the Euro depegging years back, where it literally killed banks and institutions and traders and brokerage firms. Like it was that bad. And there was no way that you could have protected yourself from it. That's where we're at basically right now. And that's why I'm telling you, be careful with currencies. Pound moving a lot better than the euro. So again, I just count you to go back and look at that live stream I did back then. I'm just showing you the chart here because what I said there, you're seeing it now. Gold, we have closed in this area here, which I said I would prefer it to stay open. As long as that stayed open, then new all-time highs would be expected. They came down, closed that in. The bodies did not close below that high of that candlestick, which would be the low of the buy side and balance sell side inefficiency. All these wicks in here look like accumulation to me. I mean, I'm not certain or convinced that the gold market's done going higher. All the things that are there for the gold market that had been going up, none of it's went away. So to me, I just think this is a nice, healthy retracement. And then this is a smaller retracement before another leg higher. I'm still bullish on gold. I don't have any reason to expect it to have topped here yet. Like there's the Dow, and we talked about how that was the only indice that made the higher high in relationship to the S&P, which failed to make that higher high. So we went down and took out that low there. I told you to have this on your chart, and it came right back up here on the day that it caused the crash, and it melted down here, and then finally back into the NASDAQ. So we're consolidating. These are very, very painful days when you try to look for a move down into the opening range gap. It's very difficult to fight it when it's showing one-sidedness. And everything that I've highlighted this morning was showing that one-sidedness to the upside. So it's very difficult for me to articulate without referring you to all the previous lectures I've ever talked about, where it's in all of the banter and all the monologues and all the talking points. Those are the things that I'm sharing in 3 decades of experience, what I'm focusing on. When do I focus on? When do I not focus on certain things? But you can see here, the market's reaching up another scale of minor buy side here. So we had a minor buy side here. It traded to that. And they left this high and we're real close to it. So you have to watch and measure, does it want to close above this high? And if it does, it needs to reach and close above that quadrant. This quadrant is anchored to that hourly dynamic range below the balance price range and the low point I gave you when we were on the hourly chart. By having workspaces toggling through back and forth, or having your layouts have time frames that are basically the same one you're watching at the time, and they have the levels on them. Like in other words, you can have a chart over here, upper left-hand corner, middle, and lower left-hand corner that offer the gradient levels on the things I've shown here. And they wouldn't be on the tradable chart. And all you're going to do is visually look over here into smaller charts on the same time frame you're watching here. And you're not focusing too much on like this level here. It's already used it. This here, it's already used it. Now we're in exploration and we're seeing, is this going to be accepted by the marketplace? Is the algo going to stop here because we printed above it? We didn't even get down to the equilibrium price point and we created a rotation higher, used it, run here, ran to another higher high. What would you consider that in terms of bullish or bearishness? Of course it's considered bullish because we couldn't even get down to the midpoint or equilibrium of this consolidation. So the initial, at the beginning of the stream, I told you, focusing up to the buy side, drawing up into the levels that we've shown on the hourly chart. So far, we did not print at that upper quadrant from the hourly dynamic range. Think of this perspective much like I showed you when we were looking at the analogy of a rock climber. When you're trying to go up in price action, it's very easy to use the old reference points in the market that went lower. All you're doing is looking for all those PD arrays. By having them, you can anticipate where the footholds are going to be at in advance. And then also by putting mile markers, which is all these quadrant levels are, there is nothing more than just simply an opportunity to measure, does the PD array exist and form at that time when it trades there, at the time and at that level, what the quadrant level is, and how does it trade to it? Does it trade to it and through it and close above it? Like we're anticipating, we wanted to see it close above that midpoint here, which is on the hourly chart. So when it did that, we knew it's still bullish. Then we did what? We went to this consolidation and said the last line in the sand for morning session bullishness, it couldn't even get down to that. So that's bullish. Another run here, rallies. We took this buy side out here. We're above this quadrant. We want to see this candlestick close above this. If it does that, everything remains the same. It doesn't mean it can't collapse and trade lower. We just got it there. So now my stop loss, if I was still long, because we're so long in the tooth with this trade, I don't want to see it come back down, and it would be just right below here. If I got stopped out there on the remaining 20% of the original position I went long on in the 930, 931 candlestick, I would be content and I wouldn't feel bad about it, even if it went and ran up into that balance price range on the hourly chart. So what have I done? I've completely removed the necessity about being right. I watched price action using my concepts, not some Mickey Mouse bullshit out there, okay, not some dead guy stuff. This is the things that I'm teaching you in this YouTube channel. You're watching it with me over my shoulder for free. It's happening as I'm outlining it. I'm giving you parameters that it should not breach this level. And as long as it does not, then we are looking for higher prices. What's the next threshold? What's the next upside objective? What's the next handhold for price action? If you're climbing higher on that rock surface, your rock climber analogy, you have to know what you're reaching for next. Well, we're at the only one right before the target that I had this morning. And I don't care if this thing trades to 25,000 today. You have to know what you're willing to take and be content with and move to the sidelines and be done. If it trades here or just below that level, it would hit a proverbial limit order. Long positions for me would be completely collapsed. I could go into the rest of the day and feel like there's no reason for me to worry about being in the price action or even looking at my phone to see what price is doing, because that means I murdered it today and I'm content with enough. The problem is a new trader, you're never content. And then you're always wrestling to get in the marketplace. Even if you do find a way to make money, you're not content with it. You want to go out there and do more. Who says you have to do that? Instead of saying, I need to make more money than I did today, following a plan that worked out perfectly for me, instead of being content with that, you're saying, I want to do more of the making money. And if it means I got to do something outside of my model, then to hell with it. I'm going to do it. I can't wrestle myself into submission and exercise self-control. And I promise you, That's the reason why you're blowing your accounts. You can't find consistency. You can't sleep at night, and you're watching me, and you're watching every other live streamer, and you're watching everybody else that comes up because you think something magical is going to happen instead of you simply reining in yourself, focusing on the things that are boring. Because that's exactly what trading is. It's fucking boring because you know what you're doing, you know what should happen, and you just got to wait for it to happen in the chart. You have to wait for it, okay? It's an appointment delivery. Your stop loss might get hit. Your target might get hit a little bit longer than you're willing to wait for. Now I would chase the stop loss right up underneath that low right there and strangle the trade. I would not let it turn on me. This is chasing and running down equity. I'm not allowing it to come back down and run back over top of this leg here. So the stop will be right below there. So it either runs in my favor or stops me out and I'm content. So you've watched 260 handles in the NQ get mapped out live in real time with you all today. Price is going to tell you everything you need to know. And all you have to do is measure whether or not it's consuming the previous range, whether it be a gap or a block of price action that can be reduced down to one singular candle, which is an order block. It's a change in the state of delivery. Where markets were behaving before, now it's doing something entirely different. And it's anchored to a very specific price point. It's the opening price of a down close candle when you're bullish. Now here, because my stop will be so close to the marketplace, I could care less if it hits it here, and it's a complete release from concern. But I'm okay if it were to jump up there and run into that balanced price range. So it's a wonderful place to be in a trade because you've scaled out 80% of your initial entry would be banked. Here, if you're a new trader and you're wrestling and you can't stand it, your skin's starting to crawl and itch, now it's stopped. You stopped out in profit near the high of the run of the day. 200, almost 300 handles mapped out in front of you, okay? If you've been with me all this time and you've learned how to do this stuff and you've made a little bit of money, lots of money, or you're encouraged that you eventually will be making money, I just want to give you an applause because I make this very hard for people, not because of what I'm teaching, but I cause a lot of doubt because I don't want everybody to know how to do this. You can do what I just did today, outline everything in advance. Once you can do that, then you can start worrying about taking entries. Then you can start measuring the comfort level and discomfort level of holding on to the ideas in demo. And you have to do that for a couple months. You have to condition yourself, just like when you're weight training. You have to gradually work up to that weight over time. Trading with real money is the same way. There's a rhyme and a reason as to why I teach. I make it longer because I tuck in all the stuff that, in my opinion, for jacklegs and the assholes out there that are just absolute worthless pieces of shit. They don't deserve anything. Because before I did mentorship that was paid in 2016, I was just like this all the time. Free, free, free. What changed? People took it and started pretending it was theirs and selling it. So I had to make shockwaves in the industry, and then there it is. A really nice time teaching you all this year. And I believe that what you have right now is enough. You don't ever need to do anything. You don't need to buy my books. Everything that's going to be in those books, now you have been exposed to it here. It's on the YouTube channel. It's simple. You consume the content, and there it is. If you want to know where to start with whatever I've done recently and work backwards. That's the best way to do it. I promise you, the things you're looking for to hold your interest, if you do it that way, that will satisfy you. Postponing my actual exit because I wanted to trade up here and hit that level so I can see. Look at this. Look at that. Who knows what, baby? You see that, Cody? Just like Daddy said so.